Hi, everyone. I'm Ian Wyatt, Chief Economist for Huntington Bank, and it's been an interesting August in the markets, and we want to unpack all that, understand what's happening with the yen-dollar exchange rate, what's happening in the Treasury market, what is the U.S. Treasury doing with all of these interventions, both in the yen market and in the long end of the Treasury curve. You know, I may be an expert on the economy, but I'm really not an expert when it comes to rates and exchange rates and treasury rates. So we decided to bring in a couple experts who I rely on and who are trading in these markets every day. So first, let's talk about the yen and see what's happening. The Treasury and Japan, so the US government and Japan jointly intervened recently for the first time, I believe, since the 1980s. So we have a huge move here and really trying to stem a weakening Japanese yen and also maintain a stronger long end of the Treasury curve. So with that, I'm going to ask Mike Stockdale who trades FX every day, to help us better understand what's happening in these markets and what this action is.
Yeah, thank you, Ian. Yeah, it's been an interesting market in FX, certainly a lot of volatility. One thing about the yen specifically is the yen had been really weakened to its worst levels in about 40 years or so against the US dollars. There's a number of reasons why. One is that Japan offers much lower interest rates than the US, so the US attracts more foreign investment than Japan would. That interest rate gap, in Japan, interest rates are probably closer to like 1% or so on the Bank of Japan side, whereas in the US, we have 3.5 to 3.75% interest rates. In addition to the interest rate gap, you also have Japan being a major importer of energy products, crude oil, things like that. And so with the conflict in Iran and rising energy costs, that's hurt Japan's economy, so causing some weakness in their currency. And there's always been some speculation that, the Bank Japan Ministry of Finance would come in and intervene to support their currency. They've done that a couple times recently in the past. And at the end of July, actually did a coordinated effort with the US, the Treasury acting through the Fed to support the yen. It's interesting, and to your point, it's been a long time since we've had a coordinated intervention. They've actually intervened together in 2011, but at that time it was after the earthquake and tsunami there that hurt some of the nuclear power plants, took them offline, and there were some concerns about the radioactive spillover and pollution that was going to happen because of that. And so there was some concern at that time that the Japanese insurers would bring money back into Japan. And so there was an intervention effort among some of the major central banks to actually weaken the Japanese yen at that time. But nonetheless, it's the first time in a long time that the U.S. has coordinated an intervention with the Japanese authorities, this time to help strengthen or support the Japanese yen. So in total, it's estimated that they did about $85 billion worth of intervention to support the yen. That was at first done by Japan, and then the U.S. came in and also supported their efforts as well. The U.S. did it mostly by converting some of their euro reserves into yen to support the yen. They actually really didn't want to spend U.S. dollars to do so. And part of the reason they probably help coordinate with Japan is because Japan's a really big holder of US Treasuries. And when Japan has to intervene in the FX markets, they'll do so by selling Treasuries. And so, obviously the US feeling the pain of rising yields here recently, they did not want Japan to sell some Treasuries and perhaps put further pressure on US yields.
Yeah, and so we've also seen, moves in other currencies as well, and the overall some weakening of the dollar. Can you tell me a little bit about that? Which currency pairs where we've seen that? What's happened there?
Yeah, that's right. So the carry trade's been really popular in currency markets this year. Carry trades are when an investor or trader would buy a high yielding currency and finance it by selling a low yielding currency. And they earn that interest rate differential on the daily rollover of those positions. So as an example, you could buy the Colombian peso or Mexican peso, Brazilian real, and earn a higher interest rate. and finance it by selling the Japanese yen, the Swiss franc, or in the past, maybe even the US dollar, and take advantage of lower interest rate environments in those currencies and help earn that higher yield. Carry trades have been very attractive this year. A lot of those Latin American currencies, particularly the oil exporters, have been some of the most bought currencies this year. And largely the Japanese yen was being used to finance those carry trades because of their low interest rate environment. Um, so against the dollar, a lot of the emerging market currencies, particularly the LATAM currencies, had been doing pretty well. But in the major space, the US dollar was actually outperforming through the mid part of this year. And there's a number of reasons why, partly because the US dollar acts as a safe haven, and with the conflicts in the Middle East and the higher cost of oil and other commodities, that was supportive of the US dollar, or investors had moved into the US dollar. But also, if you look at growth dynamics, the US economy doing much better than peers in Europe, Canada, Japan, places like that, and even China seeing some slower growth. So if you look in the major space, the US was starting to outperform, and we were starting to hear about this idea of US exceptionalism again. The fact that the US has a higher growth rate, higher interest rate, and is also very attractive from a capital perspective, in that we have some technology, AI, data center type stuff that is really attracting foreign investment. And so those things were helping support the US dollar. That trend starting to reverse a little bit of late. We've had some talk about the rising yields here in the US, perhaps the Treasury doing some buyback operations to help push down the borrowing costs, particularly on the far end of the curve, kind of in that 20, 30-year, type tenor. And that has risen the idea of kind of like this US dollar debasement trade. And so the dollar has been on its back foot the last couple of weeks, and we've seen a depreciation of the dollar against most major currencies.
So speaking of treasuries, we've seen some real significant moves in the treasury market in terms of yields. Beginning of this year, as you can see on that chart, checking it out, you can see that at the beginning of this year, everyone was expecting rate cuts. So that's why it's downward sloping. What that means is essentially overnight rates are higher than 1 year, 2 year, 3 year, 5 year rates, and really only got upward sloping once you get to longer duration and higher than overnight yields. What we've seen from January to June was really the expectation of rate cuts disappeared, and we started to price in hikes, or at least the possibility of hikes, and we really didn't see the possibility of cuts. So treasury yields are typically going to be a distribution of possible future scenarios, and there are reasonable scenarios for flat rates. There's reasonable scenarios for higher Fed funds rate. There aren't really reasonable scenarios right now for lower rates. So, we have an upward sloping yield curve over the short to moderate duration. What's been interesting, though, is, if you look at that chart, you can see when you get out to 10, 20, 30, moved up a little bit, but it wasn't a very large move we had there. Now, over the last 2 months, we've really seen a move up at the longer end of the curve, as well as at the 2 year all the way out to the 30 year. We've seen a pretty large gap up in terms of yields. And that's left us with a 10 year that's testing the highest level since 2020. It's been pretty range bound since about 23. Low 4 to right around 4 seem to be the floor, to 4.6, 4.7 kind of yield has been the range we've seen. We're near the top end of that range, and the 30 years at the top end of the range we've seen in about 20 years. So hitting that range and higher than we've really seen since 08. So helping us make sense of what's happened in the treasury market, I want to talk to somebody who trades in this market every day, Scott McGrath. So Scott, help me understand what's going on here.
Yeah, thanks, Ian. And I think, as we've discussed in the past, there's so many variables out there in the economy that are driving, the reason for yields to move up or down. And the recent Treasury action is just, an additive to that list of another impactful decision that will continue to show through in how, Treasury yields are behaving. Whether it be inflation or geopolitical uncertainty, what now seems to be more coming into the forefront is supply demand economics of U.S. Treasuries. Those all impact, the level of rates where Treasuries are trading. A lot of those have been unpredictable and very volatile as you look out into the future. So we've seen bounces, but it seems over the last 6 months or so, rates have been pushing higher. I think the most recent kind of concern is longer run embedded inflation, but now you have deficits coming back into the equation. A Treasury manipulation of 20 and 30-year bonds took the market a little bit by surprise. And of course, what their reasoning was, hey, we're gonna add liquidity in this portion of the yield curve to help those bonds trade a little bit more where the Treasury thinks would be equilibrium. And the grand effect of their purchasing of those bonds is meant to lower yields in that part of the curve. And you saw that happen when they announced it. It kind of took the market by surprise a little bit, and you saw yields drop initially on that announcement date. But within a trading day and a half after that, yields were back to essentially the level it was before that announcement. And I think what's the market's trying to digest is, why is the Treasury doing this? Why are they doing it now? And is there any other concerns we should look at, given that the budget deficit for the U.S. government has grown with the Iran conflict somewhat unexpectedly, right? And you're bringing back in this, how are we going to fund the deficit and the budget from the U.S. government that isn't really seeming to slow down. So could the bond vigilantes come out and create this or force this austerity type environment? I think that's just another add-on to the wall of worry at this point.
Yeah, I mean, I think one of the challenges is right now in Washington, people ask me, when are we going to address the budget deficit? I hear this all the time when I'm out there talking to business leaders around the country, talking to folks, and they are a bit concerned because we really are running a deficit that's more consistent with the deficits you might want to run during a recession, not when you want to run when the economy is healthy. We are running an unusually large deficit. Interest costs with the rise in interest rates we're talking about have really kind of exploded on the U.S. Treasury's debt. Right now, we're looking like we're north of 1.2 trillion. This really is putting us about the largest line item or close to the largest line item in the federal budget, up there with Medicare, Social Security, defense budget. It's larger this year than the defense budget. Maybe not with the supplemental funding, but overall, it's a massive chunk of change we are putting to this. And at some point, there is some concern that the bond vigilantes will start pressuring the U.S. government. So that's certainly an area of concern. I think the other factor we're seeing also in the investment grade market, of course, is U.S. government is the ultimate investment grade asset, but it's not the only investment grade asset. Mm-hmm. There's corporate bonds for the strongest companies out there get an investment grade rating. And we're seeing in that market is massive issuance this year. We are on track to break the all-time record, which was set in 2020 when Google was issuing 40-year debt at under 2% yield. There was really low yields back then. We were at record low yields. Now we're at pretty high yields, and companies in the investment grade market are still issuing a ton of debt because they're doing a lot of investment. This really is partly the AI trade. And this all does somewhat compete. We have a huge amount of Treasury issuance. We have a huge amount of investment grade corporate bond issuance. All this kind of feeds together. And the other interesting dynamic we're seeing too is this run up in long rates. It's not just a US phenomenon. It's happening in Germany. It's happening in Japan. It's happening in a lot of industrialized countries. But the reality is too, when we talk about the budget deficit, we are not the only country running a fairly large budget deficit as well. Mm-hmm. And so what are you seeing clients? These are a lot of factors going on. As we point out, there's a lot of different reasons. I would not want to say that, whether it's corporate bond issuance, volumes of bond issuance, whether it's inflation expectations, whether it's concerns about the budget deficit, no one's really sure what's causing this move, but we are seeing this move in the markets. That is the real reality we see. What are you guys telling clients? What are they asking about? And how are you helping them navigate these challenges? And what's some popular strategies out there to handle this? Both on the FX and the Treasury side, by the way.
Yeah. And I think this is the latest example that, listen, it's almost a day-to-day phenomenon of what is the market going to digest and how is it going to handle the news that comes in or the headlines that are somewhat unexpected. So in that type of environment, you have an uncertainty with not only what happens over the short run, but what happens over the longer run. And so you usually try to match up exposure with risk tolerance, and generally with our customers that have a longer term timeline on their debt. Those are the customers that are looking at, hey, do I want some certainty assigned with that piece of my exposure? And regardless of the environment, right? I mean, I think this year's performance has proven that the market is nearly impossible to time. Things change pretty quickly. The outlook can flip 180 degrees on a dime, and if you're looking at timing the market, it generally isn't a strategy that works out in the long run. So they're looking at what's my risk tolerance, and then trying to assign some certainty to accommodate a structure that fits into that risk tolerance. So we're taking it more from a risk management, risk mitigant perspective, knowing that this could not be the end. Rates can still move higher from here. Inflation is real. Is that what's going to happen in the future? The economy seems to be chugging along just fine. So the wall of worry, so to speak, is real, and our customers are trying to act appropriately to kind of get in their risk tolerance.
Yeah, I mean, if you sat a year ago in your spot, a client would tell you, hey, floating rates are going down. I can just ride floating rates for a while. And they avoided doing swaps, and probably were not going to do 1, 2, 3 year swaps because they weren't going down enough. It was downward sloping in anticipation of this. Now, if you do a swap, you have to pay more for a higher yield. Now, it takes out some of that uncertainty. We certainly see upside risk now on the markets, but 1, 2, and 3, you're paying more than overnight. Definitely, though, highlights the problem with trying to market time. The Fed will pivot with the data, and oftentimes the data surprise us. Mike, what are you seeing on the FX side? What are you seeing clients do? How are they managing this? So what are some of the popular approaches you're talking to clients about on managing all this volatility?
Yeah, I think, a big question from our clients is, what's the direction of the dollar going to be? A lot of large corporate customers sell things internationally. So when the dollar appreciates in value, it tends to be bad for the value of their foreign sales and the value of their foreign assets. So when the dollar weakens, it actually gives somewhat of a tailwind to the value of what they're selling abroad, or the value of those foreign operations. You've seen the dollar weaken over the last couple of weeks. And so companies are starting to think about, is now a good time to get into the market and execute some hedges for the upcoming year, to protect the value of revenues and things like that. On the other side, we also have a number of customers, being a Midwest, kind of a player, and having a lot of auto suppliers and things within our portfolio. We have a lot of businesses that manufacture out of Mexico, and you've seen a really strong appreciation of the peso this year. And, a lot of that has to do with the relationship that they've built with the United States, the nearshoring trend, the manufacturing expertise that they have there, as well as record levels of foreign direct investment, and also, just trade that they're doing with the US. And so you've seen the peso appreciate in value, and a lot of companies in the US and their supply chains would actually prefer that the peso was a little bit weaker so that they could lock in hedges there as well. So we get a lot of questions and concerns about the Mexican peso for sure. On the dollar side, I think the question is, whether or not the dollar will regain some strength, or whether or not, this dollar debasement trade that we've talked about on this call, and with the themes that you're seeing in the Treasury market, is that something that can play out over the intermediate future? And, the one thing that I always kind of caution the market about is that I would, be a little bit hesitant to call for a larger systematic depreciation of the dollar. If you look around at the broader financial market, the dollar is still the major player in global finance. You look at foreign currency reserves, the dollar's still well over 50% of foreign currency reserves. In FX trading, it's still over 50% of active trades that get done on a day-to-day basis. And in terms of foreign bond issuance, even the dollar is still like 60% plus of global bond issuance. So the dollar very much plays a a main stake in the global financial markets, and for that reason, I would caution that a larger depreciation of the dollar is probably out of the question at this point. So now it's, can the dollar depreciate further this year against major currencies? And there certainly seems the potential for that to happen. If you look at option pricing, we'll look at the ratio of kind of call options to put options that are happening in the market. It seems that, based on options trading, the dollar sentiment is the most bearish it has been since February. So, 6 months or so. So it certainly seems like there's potential for further dollar weakness against the major currencies, at least in the near term, perhaps as we kind of work through some of this uncertainty in Treasury markets. So I think from a corporate perspective, you're getting a lot of volatility in FX markets. There's a lot of uncertainty as the direction of the dollar. Companies are kind of entering into their budgeting season and planning for the upcoming year. My guide would be, do your best to protect against the values of those foreign revenues and things that you're forecasting out. Certainly there's potential for a lot of risk events to happen in the market. You could see some FX volatility on that. You want to be protected. Some companies will look to extend hedge ratios or extend hedge tenors, meaning, maybe you're comfortable kind of being hedged 50-ish%, 75%. Maybe you flex up a little bit, given the uncertainty in the market, or maybe you extend hedges out from kind of being like a 12-month horizon. Maybe you look 15 months or 18 months to kind of protect some of the values that you have in place. Or if you're a manufacturer in Mexico and you want to put hedges on, maybe you start to forecast out not just 1 year, maybe you look out 18 months or 2 years and protect yourself from the Mexican peso appreciating more if that's the trend that kind of continues to play out.
Yeah, and I think this is a great lesson. The only predictable thing sometimes in the markets is unpredictability and volatility. And, I want to caution everyone, like, one of the best things to do when things feel volatile is just calm down. Don't overreact. Everyone's talking about how high the 10-year is. The 10-year was in this range, has been pretty range bound and very close to this level a few years ago. This isn't unusual. It is certainly partly showing that we're anticipating a hiking cycle across the board. This does, of course, have implications for consumers, though, because the 10-year helps price mortgages. Mm-hmm. And for the commercial real estate market, similarly, it's not just consumer mortgages. That's helping price commercial mortgages as well. And it makes it a little harder to do development when your monthly payments are higher. It's harder to make that math work, as well as we have this data center trend that really is driving up construction costs. So you have kind of twin cost pressures on a lot of development. But overall, my general theme for companies is, one, don't overreact. Two, think about locking in, whether, if a year ago, as I mentioned with Scott, if you have floating rate interest exposure, it would have been really nice to lock in close to a 3%, a low 3 handle. That's not available right now. Now, you could lock in a 4.1, 4.2. You could do a swap to floating. There are a lot of options there. But the theme there is, taking some of that volatility out of your balance sheet. That, of course, is what Mike's talking about in the FX side as well. On the yield side, you can do a lot of those moves to try and take out volatility. But because the reality is right now, we're in a fairly unpredictable market. I think the last 12 months, there's just been one episode after another. And the reality is we've kind of been in this since 2020. The Fed's really been harping on this. We've had all these shocks to inflation. Hey, we're going to see the other side of this shock, and we won't try to react to them. The challenge for the Fed is seen as we had the Russia-Ukraine war. That's obviously ongoing, but for a while it was really disrupting supply chains. We had, tariffs. We had COVID. We've had now the Iranian conflict, and all these supply chain disruptions, all these shocks to supplies really have driven a lot of volatility in the markets. And so whenever you're in a volatile time, it's probably more attractive to think about ways to take risk off. But the reality is as well is, don't overreact to this stuff. We will see volatility. The overall core US economy is still performing pretty well. We're looking at the real-time consumer spending data. Right now, we think consumer spending is tracking about 6% year-on-year growth. You back out inflation, you're still at a plus 2% kind of growth period. The overall economy is still growing. It's been driven by consumption. It's also being driven by this AI trend, and the scale of the AI investment this year estimated to be 700 to 800 billion. A good bit of that goes to products that are imported from overseas, but a lot of that is filtering down to every part of the US economy. And it is a huge trend. So we're seeing a lot of investment there. We are seeing a lot of consumer spending. And so there are still a lot of really healthy parts of the US economy that are doing well. And those are really important to remember, that we have overall a very solid economy right now. It's still doing well, but there certainly are these bits of volatility and disruption. And so, feel free to talk to these guys. They're happy to chat with you and talk about, how you can take some volatility off your balance sheet. And with that, thank you for joining us today. Ian Wyatt, Chief Economist, Huntington Bank, and Scott, Mike, thank you. Really appreciate your insights, and that's huge. Always, I learn so much every time I talk to you guys.
Thank you.
Thanks, Ian.